Hello all, welcome you to the course on corporate laws and governance. In this video, we are going to look at the recommendation of Narayana Murthy Committee on corporate governance. In the previous video, actually we looked at the recommendation of Kumar Mangalam Birla's committee's recommendation on corporate governance, and those recommendations got converted into clause 49 in the listing agreement of SEBI. So this recommendation of Mr. N.R. Narayana Murthy and his members was to do with the review of the clause 49 of the listing agreement of SEBI. So before the SEBI constituted this committee under the chairmanship of Mr. N.R. Narayana Murthy, what they did was they actually checked how far the compliance was there among the companies with respect to the clause 49 of the listing agreement. So they actually looked at the compliance by the companies on broader categories like the board of directors, audit committee, shareholders or the investors grievance committee, remuneration of directors, board procedures, management, shareholders, and the report on corporate governance. They collected the data from 1026 companies on the applicable 1848 companies. From the table you can see that compliance was very good with respect to the categories like the board of directors, audit committee, shareholders grievance committee, as well as the shareholders. These the compliance of the companies on these categories were really good, but it was not so good for the categories like the remuneration committee, board procedures, management, report on corporate governance, etc. So they could find out, like, though there were compliance, they also had with certain categories, but there were problem with respect to the compliance on some other categories which the companies have to follow under the corporate governance. So what they did was they again looked at the directors' report in the annual report of different publicly listed companies. They went through that and they found out certain things, like they found out that there were annual report and the director reports where there were no mention whether the company had complied with the corporate governance or not as per the clause 49 of the listing agreement of SEBI. There were companies where they have spoken that they have in fact told that they have fully complied with the clause 49 of the listing agreement, but there were qualifications made by the independent auditors. What is this qualification by the independent auditors? What it means is, if the independent auditors make a qualified report, that means they have made an observation that there are limitations in the annual report preparation, or there are some kind of challenges or discrepancies with respect to the procedures that are followed by the company in the preparation of the annual report. So though the companies have made a mention that they have complied with the clause 49 of the listing agreement, but there were qualified reports by the independent auditors. There were companies who have clearly told that they couldn't comply with certain areas of the corporate governance, and they have also given reason why they couldn't comply with the certain aspects of the corporate governance. There were annual reports and the director reports where they have spoken about the non-compliance, where they have made a list of areas where they haven't complied with as per clause 49 of the listing agreement, but there were no explanation like why there was a qualified report by the independent auditors or why they couldn't comply with the clause 49 of the listing agreement. So there was no explanation as such. So basically what they could conclude was there were considerable variance in the extent and the quality of the disclosures that are made by the company in the annual report. So by and large what they found out was that a committee to be formed, and the extent to which these clause 49 of the listing agreement had been used or followed by the listed companies, and what kind of improvements that can be done in the clause 49 of the listing agreement. So that was the conclusion that SEBI made after doing all these analysis. So they have told that what is the rationale for the review of the code is to evaluate the adequacy of the existing practices, in the sense the extent to which the companies are following the clause 49 of the listing agreement. And they also want to look for ways to improve the clause 49 of the listing agreement, so that the corporate governance practices among the companies get enhanced. So this is the reason why the committee was formed by SEBI under the chairmanship of Mr. Narayana Murthy in order to review the clause 49 of the listing agreement. Let us now see what are all the recommendations that this committee has made to SEBI in order to improve or in order to include more provisions in the clause 49 of the listing agreement. First set of recommendations that was made by this particular committee is to do with the audit committee. Of course, these recommendations that were made for the audit committee are all mandatory in nature. The companies have to follow that. Here, Mr. Narayana Murthy's committee have made a mention that the audit committee should review the financial statements and the draft audit reports of the company. They will have to do this review every half yearly as well as every quarterly. This has to be carried out. The audit committee should also review the management discussion and analysis section that would appear in the annual report of the company. They will have to review the financial performance of the company as well as the operational performance of the company. The audit committee has to review that extent to which the companies have complied with the laws, in the sense the regulatory environment, as well as they have complied with the provisions in risk management. The audit committee has to review the management letters or the letters of internal control weakness that were issued by the internal auditors or the statutory auditors of the company. The audit committee should also review the records of related party transactions. So all these recommendations were made mandatory by the Narayana Murthy committee. They have also made a mention that in the audit committee, all the members should be financially literate. What do they mean when they say that the audit committee members should be financially literate? It means that the audit committee members should know how to read the financial statements. They should know how to read the balance sheet, profit and loss account, cash flow statements, etc. And this committee has also recommended that one of the members in the audit committee should have the expertise in the field of accounting and finance. Again, how are we going to define this expertise in the finance and accounting? What they mean here is at least one of the members in the audit committee should have the qualification where they must have been certified as qualified in the field of accounting or finance. This is one thing, or else they should have held a position at the senior management level in the field of finance and accounting, or they should have played the role of a chief executive officer or the chief operating officer, where they have had the responsibilities of finance oversight. If they have they have done the responsibilities, or they have looked into the supervision of the financial and accounting function, then they are considered to be an expert in the field of accounts and finance. The next set of recommendations are to do with the audit reports and the audit qualifications. Again, these recommendations are mandatory in nature. Whenever a company goes for the alternative accounting treatment means that they are not following the accounting standards. They come with their own method of accounting for certain business transactions. Whenever a company goes for adopting any alternative accounting treatment, the company should justify why they have gone for this alternative accounting treatment. They should also tell, like, why do they think this alternative accounting statement or treatment would be the representative of the particular business transaction. They should also give explanation of this alternative accounting treatment in the footnotes of the financial statement. There is one more recommendation with respect to audit reports and audit qualification, and this is non-mandatory in nature. Here, what the committee felt was that the companies should be encouraged to submit unqualified financial statements. Unqualified financial statements means that the companies follow the accounting standards. It could be the generally accepted accounting principles, we call it as GAAP, or it could be the IFRS, or it could be the Indian accounting standards. Here, when a company follows the accounting standards in the preparation of their financial statements, then those financial statements are said to be unqualified. The recommendation that was given by the committee was that every company should be encouraged to submit the unqualified financial statement. Not only that, the SEBI should keep looking or reviewing the financial markets, and they should find out the conducive environment or the proper time wherein they should where they can go for making this unqualified financial statement as mandatory for all companies. The next set of recommendations are to do with the related party transactions. Whenever, of course, all these recommendations under related party transactions are mandatory in nature. Whenever a company goes for transactions which fall under this related party transactions, then they will have to get the formal approval, or they have to get the related party transactions ratified by the independent audit committee, which is very, very important. Not only that, they will have to give an explanation to the audit committee why they feel that the transactions, though they have they come under the related party transaction, why they are not on arm's length basis. They will have to give an explanation that it is not on arm's length basis. Another mandatory recommendation with respect to the related party transaction is to do with the definition of the related party. What this committee felt was all companies and SEBI should follow the definition that was given by the Institute of Chartered Accountants of India under Accounting Standard 18 for the related party. So, whichever definition that was given for related party by the Institute of Chartered Accountants of India under Accounting Standards 18 should be used as the definition for related party by Securities and Exchange Board of India too. What is the definition that was given by the Institute of Chartered Accountants of India was that a related party means one party has control over the other. Yes, and one party has control over the other. So, when that happens, then there is then it comes under related party, and one party can influence the other party in the operational and financial decisions. So, whenever a party can control the other party, and whenever a party can influence the other party in their financial and operational decisions, then these transactions are considered to be under related party. What do we mean by control? Control over the other. A party is said to be having control over the other party. That means that party has the more than 50% of the voting rights in the company, or the party could influence the composition of the board of directors in the company, or the party could influence the operational or the financial decisions of the company. When all these three things are possible, then it can be assumed that the one party has control over the other party, and it falls under related party transactions. The next set of recommendations are to do with risk management. First category under the risk management is to do with board disclosures, and these recommendations under board disclosures are mandatory in nature. Every executive management should disclose to the board that what kind of risk management policy that they have in place, what are all the procedures that they follow in assessing the risk as well as in minimizing the risk. They will have to disclose this to the board. Then next is to do with once they disclose this, what the management is supposed to do is right, like this should be whatever information that had been given by the executive management, it should be reviewed by the board. The board should review every quarter how effective the risk management policy of the company, what are all the challenges or what are all the limitations the risk management policy that the procedure has. This has to be reviewed by the board of directors. And the executive management should make a presentation to the board of directors every year. What are all, or for that matter every quarter, they will have to tell to the board what are all the different types of risks they faced and what are all the steps that they took to mitigate this risk, and what are all the challenges that they had in the minimization of the risks. All these have to be submitted as a report to the board, and the board should approve the same. The next is to do with the training of the board members. This also falls under risk management, but this particular recommendation is non-mandatory in nature. The committee has recommended that the board members should be trained on the roles that they have, how effectively they can discharge their duties. The board members should be trained on the business model that the company follows. What are all the different risk parameters that the company has? When the board members are going to have a knowledge about the business model as well as the risk profile of the company, they can take better decisions for the company. So basically, the board members have to be trained on the business models, the risk profile of the company. They have to be told how effectively they can discharge their duties. So this training is needed for the board members for their effective functioning. The next set of recommendations that we have under risk management is to do with proceeds from the initial public offering. This again is a mandatory recommendation. It is important for the management to tell to the board about the process of how they have utilized the funds that they have got from through the initial public offering. So what they will have to do is the executive management should disclose to the audit committee with respect to the application and uses of the fund that they have generated from the initial public offering. This has to be told to the audit committee, which is important. Not only that, whenever there are every year, what they will have to what they will have to disclose to the audit committee is that they will have to clearly state what are all the activities that they have used the funds of the initial public offering. That doesn't fall under the categories that they have mentioned in the prospectus of the company. So whenever they go for the initial public offering, the prospectus would be prepared and it would be clearly mentioned like what are all the activities on which they would be spending the amount, like the capital expenditure, the working capital expenditure. So these informations would be given. Sometimes they would be utilizing the funds not for those activities that are mentioned in the prospectus. Instead, they could be using for the other purposes that had not been mentioned in the prospectus. So whenever they are going to use the funds that had been generated through the initial public offering for those activities that have not been mentioned in the prospectus, they will have to report the same to the audit committee, and this report should be certified by the independent auditors of the company. And this particular recommendation is mandatory in nature. The next set of recommendations are to do with the code of conduct. It is mandatory that the company prepares the code of conduct for the board members and the senior management. When we say senior management, we mean that the management which is just below, one level below the board of directors. Like we talk about the chief executive officer, chief financial officer, chief operating officer. All these people make up the senior management. So there should be a very clear-cut code of conduct which the board members and the senior management should follow while they work for the company. And these code of conducts which the board members and the senior managements have to follow, this should be posted in the website of the company. This should be available to the public. Not only that, these board members and the senior management should affirm that they have complied with the code on every year. They will have to give a compliance report that they have followed the code of conduct which they are supposed to follow. This affirmation should be given by the board members and the senior management. And this affirmation should be certified, and it should be certified by the chief executive officer and the chief operating officer, and this declaration should appear in the annual report that the board members and the senior management have complied with the code of conduct. The next set of recommendations are to do with nominee directors, and this falls under mandatory recommendations. First of all, it is suggested that nominee directors need not be appointed by the financial institution in the board of directors unless and until there is a dire need for it. That was the first recommendation. In case the financial institution feels that their representatives should be there in the board of directors, whom we call it as nominee directors, then these nominee directors cannot be appointed by the financial institution. Instead, these nominee directors should be selected by the shareholders in the general meeting. This is one recommendation. And whomsoever is elected and selected by the shareholders as the nominee directors, they will have the same liabilities as any other directors will have. They should not work for the interest of the financial institution. It is that they have to work for the shareholders and the stakeholders, and whatever liability the other directors have, the same liability these nominee directors will also have. Similarly, the government may appoint the nominee directors in the public sector undertakings. Even in the case of public sector undertakings, when the nominee directors are appointed by the government, the same rule applies, that these nominee directors should be appointed, should be elected and selected by the shareholders in the general meeting, and they will also have the same liability as that of any other director in the board. The next set of recommendation is to do with the non-executive directors' compensation. Non-executive directors' compensation, whatever recommendation that had been made for under this particular heading, is mandatory in nature. Of course, the board members would only be fixing the remuneration of the non-executive director, and this should be approved by the shareholders in the general meeting. Whenever we talk about the compensation also includes the stock option. So they will have to very clearly state that what is the maximum amount of stock option or maximum number of stock option that the directors can have. In case the directors are given stock options, the committee felt that the directors cannot actually sell the stocks at least for a year from the date of resigning from their post in the company. So they will have, that is they have to wait for a period of at least a year before they go for selling those shares in the stock market. So the committee has recommended the maximum limit that in the sense it should be mentioned like what is the maximum number of stocks that the director can have, and it should be mandated that the directors cannot sell these stocks which they have got under the stock option at least for a period of a year from the date of resigning from their job. The board should also very clearly state the compensation philosophy that they follow with respect to the fixation of the remuneration for the non-executive directors, and they should also mention what is the level of compensation that they would be giving to the non-executive director. This should be there in the website of the company, and they should also give the details of the shares which the non-executive directors hold, which also includes if converted, which is on an if converted basis. At the time of appointment, in fact, even before the appointment, in case the non-executive directors are going to hold the shares of the particular company where they are getting appointed as the non-executive director, they will have to disclose what is their stock holding. The same has to be informed to the shareholders. even after their appointment order should have a letter or inform details with respect to the number of shares these non-executive directors hold in the company. Not that it comes under the stock option. Even before their appointment, they may be having the shares of the company. This information should be given both before the appointment as well as at the time of appointment of these non-executive directors. Next set of recommendations are to do with the independent directors. Independent directors are those directors who should not have any kind of material or pecuniary relationship with the company other than the remuneration which they would be receiving for the job that they perform. When we say this pecuniary relationship should not be there with any other board of directors or with the when we say the pecuniary relationship with the holding company, with the subsidiary company as well as with the associate company, they cannot have any pecuniary relationship. Not only with the holding company, they should not have the pecuniary relationship with the subsidiary company as well as the associate company. And these independent directors should not be related to the promoters of the company. When we say promoters of the company, it also includes the senior management. When we say senior management, anyone who is just one level below the board of directors. So they should not be related to the promoters. They should not have been the executive in the company at least for the past 3 preceding years. Similarly, they should not be a partner or an executive of the statutory firm or the internal audit firm. For they should not have served these positions at least for a period of 3 preceding years. Similarly, they should not be the supplier, service provider or the customer of the company in which they are going to get appointed as the independent director. This also includes the lessor-lessee relationship. Again, these independent directors who are going to get appointed as the independent director in the company, in that particular company, they should not have substantial shareholding. When we say substantial shareholding, it means that they cannot have more than 2% of the voting rights. And when we look at the remuneration to an independent director, this would be fixed by the board of directors. Together as a whole, it would be decided by the non-executive directors under the direction of the entire board. Next set of recommendations are to do with the whistleblower policy. All these recommendations are mandatory in nature. First thing is that whenever an executive or any employee in the particular company has feels that there is unethical practices or unfair business transaction that happens, then they have every right to report to the audit committee without getting approval from the supervisors. So the company should ensure that if the employee feels that there is an unethical practice that is happening in a particular company, they should be given the right to meet the audit committee without getting permission from their immediate supervisors. This is one thing. Next is that they should know that they have this right. So the company should ensure that every employee knows that they have direct access to the audit committee to report any of the unfair or unethical practices in the company. Not necessarily it should be violation of the law. It could be an unfair practice which the employee wants to report. So the company should, through internal circulars or through any other means, they should keep the employees posted that they have the right to report directly to the audit committee about any of the unfair and unethical practices. So they have to have the knowledge about it. Next is that the company should ensure that these employees who report these unethical practices to the audit committee should not be treated unfairly. There should not be any kind of prejudicial treatment towards the particular employee. So they should ensure that they are protected from any kind of unfair termination or unfair prejudicial employment practices. This should be ensured by the company, and they have to give as an affirmation. Every year they have to say that the company has to make a declaration that they have informed all the employees about their rights that they have with respect to reporting the unethical practices in the company. And they should also affirm that they ensured that these employees were treated fairly and they did not face any kind of unfair treatments by the company because of flagging the problems in the company. So this affirmation should be given by the company every year. The next set of recommendations are to do with the subsidiary company. When a holding company has a subsidiary company, the holding company should ensure that the composition of the board of directors or the provisions that they have with respect to the composition of the board of directors is the same as that of the holding company. That means the provision for the composition of the board of directors are the same both for the subsidiary company as well as for the parent company. Next is that there should at least be one independent director who are working in the parent company be the director in the subsidiary company too. The next is that the audit committee of the parent company, they will have to review the financial statements of the subsidiary company. So every year they will have to review the financial statements of the subsidiary company. The minutes of the board meetings of the subsidiary company would be presented in the board meetings or to the board of directors of the parent company, and they will be reviewing the minutes of the board meetings of the subsidiary company, and they will certify and they will declare that they are actually checking the performance of the subsidiary company. So this has to be done by the board of directors of the parent company, that they are scrutinizing and they are reviewing the financial performance of the subsidiary company. The next set of recommendations are to do with the real-time disclosures. It comes under non-mandatory recommendation. The non-executive directors have to be evaluated for their performance. Who would be evaluating these non-executive directors? Here the committee has recommended that it should be a peer-to-peer evaluation. For instance, a particular non-executive's performance, executive director's performance has to be evaluated. Then what they will have to do is the rest of the non-executive directors would be evaluating the performance of this particular non-executive director. So the person who is getting evaluated will not be part of the committee that evaluates. It should be a peer evaluation. Where the other directors would be evaluating the performance of the non-executive director. And these peer group evaluations would be the basis for deciding whether the non-executive director can continue their term, whether they have to be removed. These decisions would be made only by their peer. The next set of recommendations are to do with the analyst who would be analyzing the financial performance of the particular company. This falls under mandatory recommendation. The analyst has to make certain disclosure. The analyst is the one who actually analyzes the financial statements of the company, and he or she comes with a report. So what this analyst has to do is the analyst has to disclose that there is no relationship between the company for which the analyst is actually doing the analysis personally with him, or as well as with the company in which the analyst represents. So there is no relationship between the company and the company that the analyst represents and the company to which the analyst is actually performing the analysis. There is no kind of relationship exists between these two entities. This disclosure have to be made by the analyst. And one more disclosure should be made by the analyst, that either the analyst or the company in which the company which the particular analyst actually represents, they don't hold or held or intend to hold any of the debt or the equity instrument of the company for which they are actually doing the analysis. So they don't have any relationship, and they also do not hold any kind of investments in the form of debt or equity. So there is no relationship between the analyst company and the company for which the analysis is getting done, this disclosure have to be made, and it is a mandatory recommendation. We have in the previous video we have looked at the recommendation of the Naresh Chandra committee, which was actually formed by the Confederation of Indian Industries, and it falls under voluntary code. That was not a compulsion that the companies have to follow. If they follow, then their corporate governance, the quality of their corporate governance would be better, or it would be enhanced. What Mr. Narayana Murthy felt and his committee felt was that there are certain recommendations that were made by the Naresh Chandra committee can be taken, and it can be incorporated in the clause 49 of the listing agreement. So they have picked up certain recommendations of Naresh Chandra committee, and they have recommended the same to SEBI in order to include these recommendations in the clause 49 of the listing agreement. And all these were fall under mandatory recommendation. First recommendation that was made by Narayana Murthy committee, which they want this particular recommendation of Naresh Chandra committee to be included in clause 49 of the listing agreement, was to do with the CEO CFO certification. What this particular recommendation states is, as per this particular recommendation, the chief executive officer and the chief financial officer should certify certain aspects. One is that they should state that they should give a certification, and they should declare that they have reviewed the financial statements, including the balance sheet, profit and loss account, the schedule of accounts for each of this, for the preparation of this profit and loss account, balance sheet, cash flow statement, director's report. They have reviewed all these financial statements that had been prepared by the company. So this declaration has to be given. They should also make a declaration that there were no omission of the material facts, there were no misleading material facts, there were no fraudulent information in the financial statements. So this declaration have to be made by the chief executive officer or the chief financial officer. And they should also state that the financial statement that had been prepared by the company is fair and just, and they have followed all the necessary accounting standards which they are supposed to follow, and they have complied with all the rules and regulations which they are supposed to follow while preparing the annual report. This declaration have to be given by the chief executive officer or the chief financial officer. They will also have to state that they are responsible for the internal control system of the organization, and they are actually reviewing the internal control system of the organization, and if they had found out any kind of challenges, limitations or discrepancies in the internal control system, they have flagged the same to the audit committee or the internal or the statutory auditor of the company. They should also make a declaration that they are actually, if there are any kind of fraudulent activity that had happened in the company where the senior management or the employees of the companies were involved, the same had been escalated to the audit committee as well as the statutory auditor of the company. So they should also declare that whenever they had changed the internal control policies, or if they had made changes with respect to the accounting policies that they are following, the same had been informed or escalated to the audit committee and the internal auditor of the company. So these declarations have to be given by the chief executive officer or the chief financial officer. This has to be done, and this was given by Naresh Chandra committee, and this particular committee wanted this to be included in the corporate governance code, that is under the clause 49 of the listing agreement. The next set of recommendation which Mr. Narayana Murthy and his committee want to be mandated was to do with the independence of the audit committee. In the sense, audit committee should consist only of non-executive directors, and majority of them should be independent directors. This is the recommendation. They felt that all the company, whenever they form the audit committee, They should ensure that all the members are non-executive directors, and majority of the directors are independent director, and the chairman should be the independent director. The last recommendation of Naresh Chandra committee, which this particular committee wants to get included in clause 49 of the listing agreement, is to do with independent directors exemption. Now, it was felt that the independent directors should not be made to face the criminal liability, or for that matter civil liabilities which may arise during the contact of the particular company. So whenever, there should be, what they recommended to SEBI was, SEBI should ensure that the laws are created which protects the independent directors from the criminal liability as well as the civil liability. Even though they have to be protected, independent directors should be very, very careful, in the sense they should keep on scrutinizing whether the company has followed all the rules and regulations which they are supposed to follow. They have to keep on monitoring it, and in case the independent director get convicted, or they have to face the judiciary for the non-compliance at the time of this proceedings, they should never ever use the claim that they were unaware that the company has to follow the rules and regulations. So that cannot be used as a defense. Their status of being unaware about the company following the rules and regulations cannot be made as a defensive statement to protect themselves. That can never ever be done. There are few more suggestions which were given by this particular committee. First is to do with the harmonization of the Companies Act as well as the clause 49 of the listing agreement. What the committee felt was that it should be checked what are all the differences, discrepancies that are there between clause 49 of the listing agreement and the Companies Act. When we talk about Companies Act that talks about corporate governance. If at all there are going to be discrepancies, changes have to be made in the Companies Act so that it falls in line with the clause 49 of the listing agreement. So this harmonization is very, very important. Next is to do with the removal of independent directors. Whenever an independent director is getting removed, or he or she resigns from the post, the same has to be informed to the Securities and Exchange Board of India. That's very, very important. It has to be done. In case the resignation or the removal is because of the difference of opinion between the independent directors and other directors in the board, then they have to give a sufficient reason why such a decision has to be made, and the independent director has to be given an opportunity to put forth their points in the general meeting with the shareholders. This has to be done, but already what the committee felt was that this particular practice is already in place. So this has to be followed by the companies. The next recommendation is to do with the term of office of the non-executive director. The committee felt that a non-executive director can continue for a period of 9 years continuously, and it can be a period of 3 years per term. That means a non-executive director can be in the office for 3 terms, each term consisting of 3 years. When they should retire, what the committee felt was that they can retire between the age of 65 and 70, but they felt that it should be the decision of the company to decide when they want the non-executive directors to be removed from the office because of age. The next is to do with the corporate governance rating. That what the committee felt was that every company can be evaluated and they can be rated for their corporate governance practices, how good they are with respect to their corporate governance practices. Though they felt it would be good for the companies to be rated, which will motivate them to perform better, but they felt that this corporate governance rating cannot be made mandatory, but this will definitely motivate the companies to perform better with respect to their corporate governance practices. The last suggestion is to do with the media scrutiny. when we look at the media scrutiny, it is to do with the media which actually makes opinion on the financial performance of the company. What the committee felt was that the code of conduct should be there should be a code of conduct which the media should follow while they are going to scrutinize the financial performance of the companies. There should be, and what they felt was already there are code of conduct which has already been given by the Press Council of India. They have the code of conduct which these media should follow while scrutinizing the financial performance of the companies. But what they felt was the SEBI they can talk with the Press Council of India, and with respect to a better, even more a better code of conduct with respect to the way in which the media would be scrutinizing the companies. Thanks for listening.